on the first picture. And it doesn't matter if it's just artificially lowered by the central bank, or it's just the result of expansion. The result is the same, that there's discrepancy created between natural interest rate and this one imposed because of the central bank's action. So as mainly classics of Austrian economics and Robert himself underlined, the unhampered market interest rate is determined only by the time preferences of the agents. Basically, what is important to note that it cannot be negative, because we always want to fulfill our needs rather sooner than later. So in that case, or like others say, we choose money right now rather than money later. And that means, as I will later said, that in net present value equation, the discount factor must be always less than 1. But I will later come to that. So when the interest rate falls as the result of government intervention, an artificial boom starts. And this is the result of that agents are deceived into thinking that there are more resources available for the projects and for starting new undertakings. And what's especially important is that it has a greater effect on lengthy projects. So we engage more resources in larger period of time. So what I like to focus on is rather corporate finance approach. So first, there's obvious conclusion that if we pay less for a debt, it's obvious that we will incur more of new debts for the company, because it gets cheaper as a way for financing their activities. And because of that, and because of this new, lower artificial interest rate, basically entrepreneurs prefer to invest in fixed capital. This is happening because basically, like I said, more lengthy projects acquire more value because of decreasing the interest rate. So when we lower the interest rate, it's more attractive to invest in time-consuming projects, which is represented by fixed capital. There is an obvious flow in that thinking, because, for example, when depression starts, because entrepreneurs invested so much in fixed capital, it's much harder to liquidate that. And the losses are bigger when the depression comes or when the interest rate rises again. Basically, central banks prefer to keep interest low because they think it boosts economic activity of agents. But actually, as probably all of you know, since we are on the Austrian conference, it's not so simple in that case. And actually, we basically, there's occurrence of malinvestment in an economy because of that. So first of all, probably some of you are familiar with this equation of net present value. Basically, what we do is that we take every cash flow and discount it by 1 plus interest rate to the power of the number of units of time. So basically, what it does is just somehow tries to present future cash flows in today's money's term. So how much future cash flows worth? So as you can see, it's less than their nominal value. And what I want you to pay attention to is the profile on the NPV, net present value, which is on the chart. So first indication is that the net present value increases as the interest rate falls. So the lower the interest rate, the more projects appear to be profitable. So we can engage in more projects and have a positive net present value in that case. The second one is that the chart is curved. So the net present value becomes flattened as the interest rate falls. What does mean is that when we, for example, have this one project on the chart, if we compare it with some other projects, which is more lengthy and takes more time, consumes more capital for a longer period of time, its profile will be more flat. It will intersect at the lower point, interest rate axis, and later on it will be more flat than this one. Basically, why I put this equation is because most of the companies, when they try to engage in a new project, they have to somehow rank the profitability of their investments. So, in other words, if they, for example, have to choose between two courses of action or more, the net present value is a pretty convenient tool for that, because you can compare even two completely different courses of action in that case and bring it to the same measure. So, what I want to tell is that it has some flaws because it does not take into account risk properly, especially interest rate risk. So there's a measure which is capable of capturing some of the risk associated with interest rate change, and it is called duration. Here is an equation for duration. It's not very complicated. Basically, you take what its net present value and multiply it by the unit of time and divide it by the net present value itself. And it creates the duration measure. So just to illustrate to you how it works, basically in the column 2 we have some cash flows. At column 3 we have a present value factor, which is basically, for example, for row 1, it's 1 divided by 1 plus interest rate 5 to the power of 1 at the case, and we create present value factor at that point. And later on you just multiply it how it is shown. And what we do to count the duration is we take weighted cash flow sum, which is 30,000, and divided by present value of cash flows. And in that case, we get the duration of the project. Basically, there are a few things to remember about the duration. First, it represents the average time investor is waiting for their money to be retrieved from the project. So it's, in some term, measure of risk associated with that. Because if we have to take longer for a project to bring some positive cash flows, basically we take on ourselves a bigger risk if the economic situation changes. Duration of a stream of cash flow is always less than the time of the last cash flow, which is pretty obvious in that case. And the difference between a project's life and its duration is relatively small for shorter projects, because we end receiving cash flows earlier, but increases as the life of the project is increased. Duration varies inversely with the discount rate used. The higher the discount rate, the shorter will be the time till average present value dollar is received because of the discount factor in the equation. And for a project with a 0 positive net present value, at the certain discount rate used, duration increases at a decreasing rate as the forcing life of the project is increased, but it is bounded. It is bounded until the last cash flow time. Duration is relatively insensitive to the discount rate used for shorter-lived project, but becomes more sensitive to the discount rate as life is increased. So I will show you how that works on an example given by Fuller in his paper. This is the wooden and steel bridge example. We see some of its difference, like the wooden bridge is shorter and steel bridge engages capital for a longer period of time. And the most important difference to be noted is that we have to wait 2 more years without positive cash flows for a steel bridge return. So basically, duration is a good measure of how much net present value will change if we change interest rate even just a bit. For example, we take first row, interest rate 1%. Duration of the wooden bridge is about 2 years. Net present value 941. But if, for example, we raise interest rate by 1%, we get just a slightly change in net present value, both in nominal and relative term. In nominal, it's a loss of 57 units. In percent change, we lose about 6% of the value if the interest rate is being raised by, for example, central bank action or anything happening in capital market. In the case of Stillbridge, we get much higher net present value, about 2,500. But if we just rise by 1% the interest rate, we see that the loss of the value is much bigger. We lose almost 500 units and 18% of net present value change. So we see a similar pattern in later rows. So duration is somehow a measure to capture this influence of interest rate and how sensitive it will be for the changes. So we see that, for example, at most of this interest rate, it will be more reasonable, for example, to choose a Stillbridge, but we may lose a lot more if the interest rate gets high enough. Because at about 5.38%, these projects are indifferent. There are some ideas about including the duration in capital asset pricing model. It's not very favorable in Austrian society, but still, my reasoning was that if it's actually used in capital budgeting or it's used by companies not to predict some events, but just to somehow evaluate discount factors companies should use for their projects, we should maybe use higher discount rate than the one actually imposed. So this is the idea to capture somehow this relation. So basically we take a similar equation, and the major difference is that we have this duration implied factors before beta coefficient. Basically, the lower part is just the duration, assuming that there's an equal cash flow everywhere, and the one at the top is basically calculated by iterating over. So in this case, I've calculated the value, for example, for 5% discount rate, which at the moment seems that the Stillbridge is more reasonable investment because it gives a higher net present value. But if we take risk-adjusted discount rate, we see that this is actually not the case. And if company would use more risk-adjusted measure, there may be less risky for them, or there will be less liquidation in terms of, for example, depression happening. And this is all from me.
Thank you very much to Professor Kruk for her interesting presentation. I'm sure she's eager to answer your question. Please.
My impression is that your approach becomes the more valuable, the better our predictions of future interest rate movements are. And this leads me to the question, assuming that my interpretation of your talk is correct. What do you think about the predictability of interest rate movements? Mm-hmm. Are they usually high, or are they usually very uncertain? What's your idea about that?
Mm-hmm. Okay, so I see what's the point, because we basically cannot predict what will interest rate will be. But if we, for example, on average, will prefer projects with shorter duration, we put ourselves in less risky position, and that's the main thought of the lecture. Because if we cannot be sure if the interest rate goes up or goes down, the less risky choice for us will be to choose the project with shorter duration, even if it means less net present value.
Another question, please. Be precise and short. Okay.
Thanks. Hello. Well, I just wanted to ask you, what do you think of the utility of nominal interest rates, given the fact that interest rates are actually the combination of billions of time preferences, mm-hmm. Therefore they cannot be predicted?
Yeah, they cannot be predicted, but somehow companies on the market have to predict their cost of capital, for example, and they have to discount the future cash flows. So there cannot be 1% accuracy in their predictions, but the closer we get and the less faulty our approach will get, the better it is. So I just want to push that in this right direction.
Perfect. Thank you.
We still have another question, please. We have time.
Hello. Just a small comment. I work with corporate finance too, and I think it's very good. You know, your article actually, because it's difficult, I think, for people that looks from outside. They are thinking about how interest rates creates more investments. But what you show, and I lived in my real life also, is that actually the problem actually people pick up the wrong investment. And I think this is the importance actually what this is. I think we will keep with the wrong interest rates and things like that. But the truth is actually on inside the company, what happened actually that that we have a lot of people picking up the wrong investment instead of the right investment. So congratulations. I think it's very, very clear. Thank you very much.
Thank you.
Last question, please.
Yeah, hi. That's quite interesting. Yeah, I'm also working in the corporate finance area. I want to ask you whether you have checked actually the notion of peak funding, because it's not only about NPV and IRR and the payback period, it's also about the absolute amount of, let's say, the funding. And have you looked at that?
I haven't looked at that, but it's a good idea. I may include it in the further development of my paper. But about the payback period, actually it's also a good measure of liquidity, but for example, duration approach suppresses it on many fields.
The last one, please.
Hi. I'm pretty sure this is a tacky question, talking about the economics of climate change and of resources, where Nordhaus has argued that instead of a market discount rate, you should set the discount rate for ecological destruction or the use of natural resources much, much higher than the market rate, given the fact that net present value changes. When you destroy a rainforest and you plant eucalyptus or sugarcane, whatever, a plant that destroys the environment, you do not have a constant stream, but a declining stream. It may be high initially, and then it declines, where at the same time the returns from keeping the rainforest as a genetic reserve are zero at the moment in market terms, but will rise exponentially ad infinitum in the near future, possibly.
Yeah, it is possible, but still, I think if taking this into consideration, could actually produce more uncertainty without the calculation, but still, this is because these predictions often, for example, assume that there's no technology progress. We all seen predictions that, for example, oil reserve will end in the 90s or something like that. So basically, I don't see at the point a clear method to include added capital budgeting, because it could cause more error than benefit.
Okay, so thank you very much for your presentation and your answers as well.
Thank you.